As last year, 2022 starts under great uncertainty. Not only will the economy remain in the grip of the pandemic for longer than expected, but the broader macroeconomic and financial situation does not yet seem to have stabilized. Quite on the contrary. But despite this grim backdrop, we do expect that 2022 will see new steps towards normalization of the economy. Omicron is a prime source of uncertainty. This virus variant only releases its secrets sparsely, and so at the current juncture it remains difficult to estimate its economic impact. Early 2022, the crucial question remains unanswered, namely, will this sharp increase in transmissibility be sufficiently compensated by decreasing risk of hospitalization or mortality? Frontrunner cases such as South Africa, Denmark or the UK give some hope that the Omicron variant or the Omicron wave could ultimately remain manageable. But there is no certainty yet. And there remains the economic impact, which can be substantial in the near term due to labor dropout as a consequence of illness, quarantines or tighter health measures. And uneven progress in booster vaccines also means that Omicron is still threatening global supply chains, possibly resulting in new supply disruptions, for example, as is the case in China. Now, despite the pandemic, the current economic outlook differs drastically from that of last year. Following last year's robust economic recovery, many advanced economies appear to be entering a late cycle phase in 2022. Whether this means that the economic recovery has entered the end phase, however, remains an open question for the time being. But there are clear signs that economic recovery is past its peak. For example, leading indicators for the major economies suggest continued economic growth, but at a slower pace. Moreover, countries are still encountering significant supply constraints. For instance, labor markets in the US and increasingly so in Europe are tightening by the day, and supply disruptions continue to weigh on the economy for the foreseeable future. Just think of the current production constraints in, for example, the car industry. We do expect supply constraints to ease gradually over the course of 2022, but we are less optimistic about labor shortages. Persistently lower participation rates and low unemployment, especially in the US, suggest continued tightness in labor markets and thus possibly also increasing wage pressures. And on top of this, we also see a slowdown in the growth in China, a gradual consolidation of fiscal policy in the US and in Europe, while the pandemic continues to weigh somewhat on the growth in the coming months. So in summary, we do expect economic recovery to continue, but at a slower pace. And so for 2022, we expect growth to be 3.5% in the Eurozone and around 3.6% in the United States. Slower than last year, but still significantly faster than the long-term average growth. But the big difference between this year and last year lies mainly in inflation developments. Unlike in early 2021, inflation today is reaching record highs. Headline inflation in the US now stands at 6.9%, while in the Eurozone it stands at 5%. And inflation rates in individual countries are in some cases well above this European average. Inflation also proved more persistent than initially expected due to the series of supply shocks, such as the supply constraints that we have seen, due to very strong reopening demand, and late 2021 also due to the gas and energy crisis. For 2022, we nevertheless expect inflation to gradually decelerate on the back of weaker inflationary impulses, as well as important base effects. However, this outlook hinges on the absence of new extreme shocks, such as energy prices or wage inflation, and also on the anchoring of inflation expectations. In the short term, last year's higher energy prices and production costs will continue to have an impact on inflation for some time, but those effects diminish as the year progresses. Meanwhile, the inflation surges do worry central banks. They are now increasingly prioritizing on curbing price increases and on anchoring inflation expectation. At its December meeting, the Fed, for instance, already drastically reversed the course of monetary policy. It announced an acceleration of the tapering and, possibly more important, hinted at the start of interest rate hikes in the course of 2022. The Bank of England also tightened policy, unlike the ECB, who did announce the end of purchases under the PEP program, but continues to swear by current, extremely favorable financing conditions. And these signals from central banks are being picked up by financial markets. Bond markets are now pricing in imminent rate hikes, as reflected in the rise in both short and medium-term yields. And equity markets are correcting and rotating more and more from growth to value stocks. A clear sign that these markets are taking into account persistent interest rate increases globally. In short, 2022 clearly begins on a different start than last year. But that doesn't make the challenges any less daunting, and uncertainty remains high. The pandemic is entering its third year and the economy remains unbalanced for the time being. High inflation is a clear sign of this. And against this background, we expect the economic recovery to continue and central bank interventions to gradually bring inflation back under control. But this is likely to come with high volatility, and so we enter 2022 with a somewhat sour-sweet outlook.